So, what is value investing? Now that you know how to invest, what is value investing? Value investing is based on the philosophy, on the train of thought, that one is able to purchase a share at a price which is below its actual worth. It's a bit like saying that you want to buy value for your money. That is it. It is a very simple philosophy. A value investor is someone who wants to buy a company's share worth $2 for $1. When a value investor purchases this share at $1, he believes that the market will eventually realize the price of the share is actually worth $2. Thus, the market and investors in it will bid up the price until it reaches that $2 mark. And there you have it. You have bought a share for $1, which is now worth $2. I will explain this deeper. Please bear in mind that value investing goes hand in hand with a long-term outlook. You need to be in it for 5 years plus in order to really see the rewards. If you are a long-term investor, then growth and value investing philosophies are your best bet to beat the market. If you are into short-term investing, then you should take a look at technical analysis. The reason why I advocate a long-term investing outlook is just because it has been the long-term investors in history which have been able to derive the true benefit from the stock market in the form of wealth creation. Short-term technical analysis traders are able to create immense value for themselves. However, long-term investors have been shown to create more wealth. Now, interesting fact, you noticed I was talking about investing philosophies. There are many of them. You have the value investing philosophy, the growth investing philosophy. These are your most common, I would say. But you also have other investing philosophies such as technical analysis. These other philosophies, however, are outside of the scope of this work. Now, let's get back to the house analogy. But this time, let's assume that you and everyone else on the market can only buy a 10% portion of a house, of a property. So, you're looking for a house in a suburb and you come across two potential choices. Both of these houses are identical. Good location, modern build, the same. But you can buy a 10% of house A for $10,000, whereas a 10% portion of house B is currently going for $15,000. You, being the value investor you are, can easily tell me that house A is the better bet. This is because you are getting the exact same when you buy house A as you would if you bought house B. So you go ahead and purchase the 10% portion of house A for $10,000. Just a heads up, remember this means the whole house is currently worth $100,000. You paid $10,000 for 10%, therefore the $10,000 divided by 10% gives you $100,000. So you now own 10% of house A, while the other 90% of house A is made for other investors. What would happen in the market? Other people looking to buy property will see that house A is a much better value for money proposition than house B. Consequently, you and all the other people who hold shares in house A will have multiple people demanding those shares. Obviously, you wouldn't sell them at $10,000 with all this demand. You would want more for each share. So, another 10% shareholder in house A sells his portion for, let's say, $12,000. Then another 10% shareholder in house A goes on to sell his portion for $14,000 until eventually the price is bid up all the way to $15,000, because at this point those people looking for a house would either invest in house A or house B. At the end of this process, your $10,000 investment is now worth $15,000. You managed to identify a property in the market which was selling for substantially less than what it should have sold for. This is value investing at its core. I'm now going to throw a spanner in the works. What if we have the same scenario with house A and house B? Let's drop the bit where you can only purchase a portion of the house. That was just to demonstrate how demand will drive up the price, but I want to keep things simple. So, the whole of house A is worth $100,000 and the whole of house B is worth $150,000. But now, I tell you that besides the homes being exactly the same, i.e. same area, same size, I tell you that house A is a very old house, whereas house B is a modern, newly built house. Then what? Being the value investor you have realized that the lower price for house A might well be justified, given that the property is old and not modern. So what do? Does that mean house A is a bad investment or a worse investment than house B? It depends. The intelligent value investor would proceed to search the suburb for similar properties in size and finish, i.e. other properties which are old. You may find that other old properties in the suburb which are the same size go for $120,000. This would tell me that house A is still undervalued, as it is only going for $100,000. The key here was that we had to find something in common, being the quality of the house, in order to determine whether house A was in fact a good investment. This brings me to my next and most crucial point, and relates to something I have already mentioned. As a value investor, you want to get an investment which gives value for the money you paid. The value being the quality of the house, the money being the price we pay. This is the trade-off, and we as value investors need to determine if, for what are we paying, we are getting more value for our money than similar houses. This principle, furthermore, goes for anything one purchases in life. We all want to pay the least amount for the maximum value, i.e. you want to minimize the amount you pay and maximize the amount we receive. I know I'm drumming this concept with the house in, but these abstractions are crucial to understand.